What is an IPO and what does it have to do with a stock? Understanding what an IPO is one of the major building blocks of understanding how the stock market works. IPO stands for Initial Public Offering. Before we get into what that means, let's first understand that companies do an IPO to raise capital or money. Companies have various reasons to raise capital. It could be for expansion of business, marketing needs, or raising funds for a new product. Say you have a bakery called Adrian's Bakery. You've been in business for 6 months at one location and you got a lot of positive feedback from your clients and customers. You want to expand by opening up 5 new locations in 5 different states. In order to do this, you need money. You know you will make that money back, but as of right now, you don't have the capital necessary to invest. So you have several options. You can go to a bank for a loan, in which case you will have to potentially pay high interest. You can go to investors who may want a large percentage of your business in return. You can try to go to your friends and family and ask them for money, but they may not be able to offer you enough. Or you can file for an IPO. Which brings us to the topic at hand. An initial public offering, or IPO, is basically a company or corporation asking the public for a specific amount of money in exchange for shares of that company. That amount of money is divided up into hundreds, thousands, or millions of pieces called security, also known as stocks, and then are purchasable by anyone trading in the stock market. To further explain, say you need $5 million to open up these 5 locations. That $5 million can be divided up into 100,000 pieces, which would make each stock price at $50, because 5 million divided by 100,000 is $50. The stock price of your company would then be at $50. Say investor A has $40,000 and wants to buy shares of your company. He would be able to purchase 800 shares of your stock. The price of the stock and how much money an investor is willing to trade will determine the number of shares they will be acquiring. A definition that I want you guys to remember is the following. Volume is the amount of shares equally being traded at any given time. This is important since it will come up in later videos. The collection of all the stocks in the market are split up into different groups. These groups are called indexes. Depending on the type of stock and various other factors, a given stock will be placed in a specific index. Here are the most popular indexes. The first one is the Dow Jones, which is basically 30 major companies with a track record of stability, such as Apple, Disney, Walmart, Microsoft, etc. Next, we have the New York Stock Exchange, which is the largest stock exchange that includes stocks from every industry. Next, we have Nasdaq, another large stock exchange that is comprised of 4,000 common stocks. There is also the S&P 500, which is a mid-sized stock exchange comprised of 500 stocks. And finally, we have OTCBB, which stands for Over-the-Counter Bulletin Board, which is comprised of penny stocks and new stocks that are generally deemed to be unstable. A stock can also be listed in multiple indexes at once. It is generally assumed that the popular stock indexes mentioned are more stable than some of the other less popular indexes. I hope this better helps you understand what an IPO is and how it relates to the stock market. In the next video, we will discuss how exactly a stock price goes up and down and how investors can lose or make money. I'll see you guys at the next video.